Welcome back to the Armchair Traders Investing Markets and Money podcast. And this morning we're talking about investing for dividends. And on the podcast, joining us today, we're very pleased to have Martin Connaghan, who's joining us from Aberdeen Asset Management, where he's a senior investment director and also the co-portfolio manager of the Murray International Trust, which is a London-listed investment trust, which we will be discussing in a little bit more detail on the podcast this morning. Welcome, Marty, to the show.
Thanks very much for having me, Stuart.
So firstly, just for the benefit of our listeners, I was wondering if you could give us a brief overview of the Murray International Trust and what it sets out to do.
Certainly. Murray International Trust is a global equity income investment trust. It's been around since 1907. And its investment objective is to deliver an above average dividend yield. So by above average, we sort of take the AIC classification of global equity income trusts, excluding Murray International, and take the yield of that collective and then try and deliver a yield that is above that. But the difference is that we then try to earn that dividend, to cover that dividend. So we're not covering it from capital. There's nothing wrong with covering it from capital. It is just a different approach, and that's never been the approach at Murray International. So if the yield is 4.5%, we're looking to earn that from the underlying securities, and then to grow the dividend and the capital in real terms. So ahead of inflation over the long term. So you'll note that there isn't a benchmark mentioned there. Murray International doesn't have a benchmark. It certainly doesn't look like a benchmark or behave like most global benchmarks or the way that they're made up these days. It does have a reference index, which is a FTSE All World. But it's probably best way to think of it, I guess, is an income fund in the sort of traditional sense of the word, or product. So where income is making up a sort of sizable amount of the total return over the long term.
And just for clarification, it invests in companies that are paying dividends rather than looking for income from other asset classes like bonds, for example, or corporate debt or that kind of stuff.
So we do have the ability to invest in fixed income. That's been an allocation that we've used sort of opportunistically twice over the last 20 odd years. We used it in the sort of early to mid sort of noughties, 2004-05. But that was really driven by equity yields being very, very tight at that point. So covering a yield of 4.5 was quite difficult. At that point, we shifted the allocation up to about 25% in UK gilts and US treasuries. And then again, 2014, 15, 16, we built an allocation up in emerging market debt securities, and that peaked at about 17, 18%. And again, just really done as that asset class was selling off at that time and giving us the opportunity for real yield opportunities. And that allocation has been sold down considerably over the last 4 years, and is currently residing at about 6% of the portfolio, currently residing in emerging market, both corporate and government debt securities. So it's an allocation that is available to us, but normally on the whole, it's mainly a portfolio of large listed global equities.
And just out of curiosity, when we had that situation in sort of 2020, I think it was, when a lot of companies actually suspended their dividend payments, was that too short a window for you guys to have to really worry about it and start thinking about going back into bonds and things like that?
2020 was an amazing year from initially the opportunity in terms of the sell-off that we saw in markets in the early part of that year. And, at that point, we were selling down some of the fixed income names to move into companies like Broadcom. When we bought Broadcom, it was purchased on a 7% yield. It doesn't yield that today. I think it yields about 1.2%. AbbVie in the United States. There was just some very, very good opportunities, but that window snapped back quite quickly as a result of the sort of global monetary and fiscal response to the COVID pandemic. So we did do that, but I guess your point on the question, it was difficult from the point of view that companies in a number of geographies were cancelling or cutting dividends, not necessarily because they had to, but because they were sort of being made to. UK dividends, I think, were down about 40% that year. Dividends were down about 30% in Europe. So that was challenging. Being a global fund, we have the ability to, move around that. For example, dividends in the United States were actually up about 4 or 5% in 2022, just because they stopped buying back stock and just maintained dividends. So having that flexibility of the global mandate means that we can move around the geographies if need be. But in that year, we did have to dip into reserves. Murray International has about £73.5 million of reserves that we've accumulated and built up over the years. So in 2022, it's the beauty of the investment trust structure. We dipped into reserves to maintain the dividend growth, about £9 million, and then about £5 or £6 million the year after as dividends recovered. But the last couple of years, we've got back to covering the dividends, and even last year, we managed to put £5 million and replenish back into reserves.
Now, the Murray International Trust has arguably one of the best dividend yields in your peer group. It's obviously something that you've already mentioned, something you focus on achieving. How do you feel that you guys managed to go about doing that? I mean, what's the secret sauce there?
Best way to probably try and answer that is to try and explain what we certainly don't do. So what we don't want to do is just to stuff the portfolio full of very high yield, but then potentially X growth businesses, because while you would have no problem generating, the revenue or covering the yield, you would certainly pose yourself an issue with the capital growth over time element of the investment objective. So what we try and do is take a little bit of a barbell approach to that allocation within the equity portfolio. So trying to balance lower yielding names with higher yielding names. So a floor in terms of yield is probably about 1.5% or 2%, and that allows us to make reasonable allocations to sectors such as technology or some high quality industrial names. Then there is a core of the portfolio which will have a yield in or around the sort of yield that we're trying to deliver, 3-4%, and that core of the portfolio opens up opportunities within healthcare, opportunities within consumer staples. And then at the far end of the sort of yield spectrum, yes, we do then need to have an allocation to higher yielding areas of the market to counter that allocation that we've made to technology, for example. And that will take us to utilities, communication services, energy companies. So given that the investment objective itself is a balance between primarily income, yes, but also capital, it is typical to see that balance reflected as much as it can be in terms of balancing the yield spectrum within the portfolio.
And I looking at the trust, you've got around about a 30% allocation to emerging market stocks. The two things I wanted to ask you about there, is that something you bear in mind when you're buying stocks, that okay, this is where our de facto emerging markets budget is? And then secondly, do you anticipate that increasing over the next couple of years?
The allocation has, and always will, I guess, shift, considerably over the years. Once upon a time there was more than 50% of the portfolio was in UK equities. Not because we were necessarily positive on UK equities, just again, it had to do that to deliver that investment objective. But now we can get reasonable yields in just about every market of the globe. The European rate, that's probably doubled over the last 10 years. The US rate, it's as high as it's ever been at the moment, albeit it's probably still nowhere near, most global benchmarks. But in terms of emerging markets specifically, I mean, you're absolutely correct. That is a meaningful allocation that we have, not just in terms of equities, but as mentioned, that small fixed income allocation. It's really is driven by the companies themselves, rather than us taking a sort of macro top-down view on emerging markets as opposed to developed markets. If we can find, something like a Walmex, for example, in Mexico, which is, large-scale bargain retailer, but that's a business that, generates a return on invested capital of over 20%. That's getting towards like a TJX in the United States or a Costco in the United States in terms of quality of operational efficiency and returns that they're generating. The fact that it's listed in Mexico, yeah, we need to be mindful of the currency. We certainly need to be mindful of the sort of political environment, particularly given the outcome of the election this year. But I'm sort of struggling to think of markets where we don't have to take these things into account these days. So it's been a lucrative allocation that we've made, particularly in Latin America. The sort of long run returns from the Latin American exposures about 17% annualized over the last 20 odd years. That's way ahead of the market returns. But increasing it here, I would probably say that's unlikely. 30% give or take. That's already a pretty reasonable allocation to emerging markets. We still like emerging markets driven by the companies, but to go significantly beyond that, you're kind of moving yourself more towards an emerging market fund as opposed to a global fund. So from a sort of investment objective, from a risk perspective, I think 30% probably feels adequate for now. There is no real sort of limit to that, but it's been a pretty stable allocation over the years generally, and yeah, I'm sort of short of a catalyst for us to aggressively add to it at this point.
You seem to have been getting some great results with the Asia Pacific tech sector specifically. Do you have a house view on this market, or is it just a case of there are a lot of high quality tech companies in Asia at the moment, which is something I've been noticing myself as well?
It's probably a bit of both, actually. Again, we do like Asia. We are believers in the Asian growth story. Certainly, China has had its issues these last few years, but if you look at the impact of what's going on there in terms of other Asian economies, whether that be places like the Philippines or Thailand, Taiwan, even Japan, Vietnam, I think there is Indonesia. There is a lot to like about the dynamics and demographics that we see in many of these economies. So 10 years ago, a sort of weaker China would have really have meant a struggle for Asia, but there has been an element of a decoupling there. And many of these economies are exporting far more to developed markets in the United States than they ever did. So, there is a house view that we remain positive on that as a long term trend and theme. And as it relates to technology, yeah, a number of the Taiwanese stocks that we invest in have certainly been caught up in that AI excitement, I guess. Companies like TSMC, Hon Precision, they're up 70%, I think, 90% in sterling year to date. Not sure if I would be aggressively adding to those positions up here. We have at the margin been taking some capital out of them, to fund some other investment opportunities, to do the buyback, with discounts being, where they've at, and to cover dividends. So they still remain sizable allocations in the portfolio. So they're definitely investable businesses, but I would just be wary of in allocating to them in a meaningful way, given how share price performance has been. And with the semi-related stocks in particular, I would just flag that there is a cycle there. It might not feel like it at the moment, especially when you look at share price charts, but I would just ask and remind people to maybe look at TSMC's share price chart in 2022. That stock was down, I think, about 40 odd percent by the October that year before, rallying and finishing the year down 25%. So you can wait, you get opportunities with these stocks. They're definitely not immune to gravity, but there is still a lot to like about Asia tech, Indian tech, in terms of some of the IT consultancy businesses like Tata, Infosys. Again, these stocks have done well, but they are definitely investable and high quality businesses.
And do you find that the Asian stocks are relatively consistent dividend payers as a whole, when compared to, say, European or North American companies?
Um, they're not any more or less volatile traditionally. I guess there's been a little bit more uncertainty, just as via some of the Hong Kong and Chinese names that we have in the portfolio, and the ones that we don't. For example, we did have China Vanke, which, with the benefit of hindsight, is simply an investment that Sam and I got wrong. They cancelled their dividend this year. The stock has been subsequently sold from the portfolio, but you've seen names like CR Land. They cut the dividend, but only by 3%. Ping An Insurance held the dividend flat. Hong Kong Insurance actually put the dividend, up 1%. So there has maybe been an element to some weakness and or volatility around dividends with regards to that specific geography. There's also been a little bit of, weakness or volatility within some of the Australian sort of commodity-related companies. So, BHP, they cut their dividend 14%. Woodside Energy, the Aussie-based LNG company, they cut their dividend 40% this year. But those are cuts from very, very high levels, and they are still, very attractive yielding companies. And that's sort of volatility born out of their cyclicality as opposed to their geography. So you would sort of hope never really to be caught out by that if you've done your research and forecasted the cash flows and the dividends correctly. So the Asian portfolio, or section of the portfolio, delivers about 22% of the income. But on the whole, it's just as stable. It's just growing as attractively as other parts of the regions. TSMC put their dividend up 30% this year. OCBC or any of the Singaporean banks, to be honest, looking at their capital ratios and how financially robust they are, they have very attractive yields and very consistent and very attractive dividend growth. So there's been pockets of volatility or weakness on the dividend side to focus on as it relates to Asia, but no more or no less, I would say, than any other geography of the globe.
And you don't tend to make like many changes to the trust's holdings, but we saw a big one in first half of this year with Mercedes-Benz. Can you tell us a bit more about the rationale behind that and what why you added that to the fund?
I mean, we like the fact that it was different. Consumer discretionary can be quite a tricky exposure to get when you're looking for income. And that sort of luxury space as well can be quite tricky as well. So it was something different for the portfolio, which is something that we like. And we did like the fact that it has been, weak. We always typically tend to hunt amongst share price weakness or volatility for longer term opportunity. Now, it's been weak for very, very clear reasons. I think about 18% of revenues and about 30% of volumes are, China related. So that's weighed on the story. Luxury, the space, as you'll know, that's been struggling, at times and coming under a little bit of pressure. And then more recently, just the sort of spectre or the threat of potential trade and or tariff issues has certainly weighed on the story. So there is plenty of work for myself and the team to be doing on this name and all the names, to be honest, that we expose shareholders to as we move forward from here. But this is a stock that's got very, very low expectations on it. A very attractive high, single digit yield. It's trading on 5 times earnings. So expectations are very, very low, but they have a product offensive coming on. So the new model updates for the GLE, for the S-Class. They have a new CLA launch coming. They have a new platform in terms of, the sort of basic unit for manufacturing. So they've got a new electric MMA platform, which will hopefully continue to improve the performance in terms of range. They're looking at fixed cost reduction in Europe. So even though margins did come under a little bit of pressure at the most recent set of results, we would still expect the free cash flow generation to be strong, which in turn should underpin that very, very attractive dividend and shareholder return framework via buybacks that they have. So it's an area of the market generally which is out of favour, but we still think that it is a quality brand and a company that's looking to grow the sort of proportion of its higher priced models, which should in turn improve margins and profitability and sort of reduce the volatility in earnings over the long term. So one that we're going to have to be patient with and continue to do a lot of work on, but in the meantime, receiving that quite large and attractive dividend.
And I wanted to also ask you, to what degree do macroeconomic factors, you mentioned a few already on this discussion, To what degree do macroeconomic factors get taken into consideration by the team when it comes to stock selection?
Yeah, I mean, that's the point. It's really is done at the sort of stock level as opposed to us, thinking that ECB are going to be leading the way in terms of, rate cuts. So that may be supportive to European equities. Let's go and find a bunch of European stocks. It's not really done that way, but it is done on an individual stock by stock basis. And at that point, then different macro factors will be more relevant just depending on the stock that you're looking at. So, for example, if we're talking about a mining stock or an energy stock, then, at some point in the bottom up analysis, you're absolutely going to be looking at things like expected GDP growth globally or in the key markets for the underlying commodities. You're going to be looking at, supply and demand dynamics and all that sort of good stuff. So it does really vary. The healthcare names, a lot of work this year has been done on and will continue to be done on trying to be on top of news flow and expected legislation as it relates to perhaps, drug pricing, particularly in the United States. If we're looking at a large multinational in the United States that has significant earnings from overseas, like Coca-Cola, it's about 65% of its revenues come from overseas, or Philip Morris, where all of its revenue comes from overseas, then, we need to take into account the strength of the dollar and the expected direction of the dollar from here, because that can have a significant impact, on the earnings translation. So it really does depend on the company, but it is an important part of what we do in terms of the analysis. And we always try to come at it from uh, managing the risk, but also looking for opportunity as well, because there is always both sides to be had. If you're thinking about, inflation, for example, well, where is that inflation coming from? So let's think about potential opportunities. Is it coming from commodities? Then, let's go and look at some commodity opportunities, perhaps, but then also making sure, looking at the risk perspective from that side of things. So making sure your companies have got pricing power, for example. So it depends on the company, it depends on the sector, but it's a very important part of even the bottom-up analysis.
And finally, I just wanted to ask you about the trust's defensive characteristics. This is something that analysts have highlighted. They said it's a very good investment because of its defensive characteristics. Can you explain a little bit about why the trust is rated like that, and what the attraction is for investors?
So I guess what the analysts are meaning in that, the trust, or if and when markets fall, then the portfolio has sort of proven itself to be quite resilient and guess relatively robust from an NAV and share price performance perspective. So if we think about a more recent example of that in 2022, I think markets were down. Global markets were down about 7-8% that year in sterling terms. The trust performance was to be up 7 or 8%. So it's that's what they're I believe they're saying when they're making those comments, and it's how we it's not something that we necessarily set out to do. What we set out to do is to deliver that investment objective that we covered at the start of the conversation, and in just trying to do that, that is going to result in meaningful allocations to consumer staples and healthcare, or utilities, communication services, and areas of the market which should or have been historically at times defensive in nature. So it's just really a different approach. Rather than trying to beat markets year in, year out. If the market's up 10, you're trying to do 13%. The shareholders tell us that there's plenty of funds out there for them that are geared up to do that. But in this environment, to be doing that, you need to be holding a considerable allocation to quite a narrow band of stocks, which is fine until it's not. So our sort of primary aim is to try and preserve capital first and foremost, and if we can do that, preserve capital if and when markets fall, then we don't need the portfolio to be working as hard for us, if you like, when that upside returns. So we're never really going to be participating in every single bit of upside. particularly when that upside's been driven largely by a narrow band of very low or no dividend yield paying companies, which are not appropriate for this specific mandate. But if we can preserve capital initially when markets fall and then grow it to a meaningful way, then over the long term, point to point, you can deliver very attractive total returns for shareholders, but just to do it in a very, very different way. And it's that different approach that I think some shareholders are glad to have as an option to them, given the environment and given that there's plenty of options for them in terms of stocks that will try to shoot the lights out every year. That's not what this trust is. We're not a very exciting bunch, unfortunately, but we believe that there is a place for that allocation alongside these other funds, which are performing very, very strongly this year, to, in balance over the long term, deliver the desired level returns for the various types of clients and shareholders that we have.
Well, given its assets under management, it's obviously attracts a lot of investors who like those parameters and feel it's got a role to play in their portfolio. Well, thank you very much indeed, Marty, for coming on today and talking about the Murray International Trust. That's been really, really informative. I really appreciate it.
My pleasure. Thanks, Stuart.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.